Well, welcome back once again. As I said, the content just keeps getting better and better, and we're in for another treat. We have coming up a fireside chat with Nicole Glaros. As you heard Josh speak of her earlier, Nicole is the Chief Investment Strategy Officer for Techstars. And this conversation will be moderated by Gordon Doherty, President and co-founder of Capital Factory. So we have some heavy hitters here. Enjoy.
Thank you. Excited to be here. I'm Gordon Doherty. Nicole, welcome. I'm looking forward to this session with you. The audience knows this, I think, if they looked at the agenda, but we're the last thing between them and an exciting pitch competition. But the cool thing is I get to talk to you about fundraising and what it's like to be a female fundraiser, what it's like to be a female VC. So I know it's going to be a super interesting topic for everybody that's on today. So again, Nicole, thanks for joining me today.
I'm excited to be here, Gordon. Thanks for having me so much.
You're super qualified for this. Obviously, we wouldn't have you here if you weren't, but you've made a lot of investments. I understand you've invested in more than 90 companies. Entrepreneur Magazine named you as one of the 7 most powerful women to watch. So you come in with some good credibility, but you work for an interesting fund, the Techstars Fund. And it's not like most of the traditional funds in a couple of different ways. So I thought just to get started so the audience knows a little bit more about your perspective as you answer my other questions, what would you tell us about the Techstars Fund?
Yeah, well, I think Techstars is an interesting beast to wrap your brain around. We call ourselves Techstars, not the Techstars Fund or anything like that. And we really think of ourselves as sort of the ecosystem to help entrepreneurs succeed. So if you follow Techstars or you know anything about us, we invest in 2 ways. The first way is when companies come into our accelerator program. The accelerator is the sort of building block on our investment strategy. And it's also how we best support entrepreneurs. So it's like a boot camp for entrepreneurs for 13 weeks. And we put them in a high pressure situation where they're surrounded by mentors and they're surrounded by peers and they get to execute like mad over 13 weeks. But that first piece is where we invest. And then the second piece where we invest is in follow-on in some of the companies. We take a very, so I would say on the accelerator side, we take a very boutique investment approach. And what I mean by boutique is if you think about a traditional VC, they sit down with founders, they look founders in the eyes, and they try to make investment decisions based on 3 or 4 or 5 meetings. And so at the accelerator level, we do that exact thing. By the way, we make 500 of those investments every year globally, wow, which is in addition to the 2,300 companies that are already in the Techstars portfolio.
Yeah.
But on the follow-on side, it's a little bit of a different approach. It's more of an algorithmic approach, if you will. And so we have limited capital there, and how learning to deploy it or how to deploy that capital across that existing portfolio can be tricky, especially when you have as many companies as we do in the portfolio. So just for a little, understanding, last year alone, we looked at 518 transactions, 518 financings happened inside of our portfolio.
Okay.
And that was $2.1 billion that was invested across those 518 transactions. So it becomes a little bit of a machine on how to make follow-on investment decisions.
Yeah.
And I would say that our heroes, one of the people that we talk a lot about is John Bogle. If you know who John Bogle is, he's the founder of Vanguard. And if you've ever read any of John Bogle's books or you invest in public markets at all, one of the things the fun conversations are, what's better, an actively managed portfolio or a passively managed index fund? We kind of split between those 2 things. We're not an index because we don't have access to the entire startup ecosystem, and we are having to make individual investment decisions. But unlike a traditional venture fund, we believe in a highly diversified approach, just like an index fund does, and make decisions that way. So we've got a set of rules that we look at, and a lot of times the rules are actually independent of even how the startup is performing or doing. It has to do a lot with the financing, the rounds, and who's in the rounds, and what the investment landscape looks like. But when we create those rules, then we can make faster decisions and try to get a little bit more capital to the companies that need it. So Anyway, like as a boutique individual VC, I've done a little bit more than 90. I think it's close to 100 investments now. But outside of that, it's in multiple hundreds.
Yeah, you probably don't even know the number. It's just a ton. Yeah, that's operating a fund at scale for sure, and just the deal flow that you're managing is really unbelievable. And of course, Capital Factory and Techstars, our partnership goes back a long time. I mean, Techstars Austin launched out of Capital Factory. When they first moved to Austin, we said, well, hey, why don't you just use our office space? And so like that kind of really kicked off the relationship that's been very long term. We're co-invested in lots of companies. We've had startups that have gone through both of our accelerators, sometimes Techstars first and then Capital Factory, sometimes the other way around. So it's a very strong partnership that we appreciate very much. I'd love the audience to learn a little bit about your path to venture. I find a lot of graduates and a lot of professionals that are early in their career would aspire to move into venture funding. You started your career as an operator, if I understand correctly. Did that time as an operator help you or hurt you in terms of a path into venture? I'm curious.
That's a good question. I mean, I think that most people get into venture one of two ways, either as an operator with a success under your belt, and you're like, I think I'm going to start a venture fund, or I'm going to join a venture fund, and that's path one. Or path two, which I actually think is the harder path. I don't want to say harder. I would say the less common path is working your way up. So you start as an associate and end up as a principal, and then maybe as a partner, and then as a GP. I see that happen less, although it does happen. More often, at least from my perspective, more often it's the operator path. But that wasn't actually my path, which was kind of interesting. Okay. So I did start a company when I was in college, and I started that company because I was looking at, so first of all, I come from a long line of entrepreneurs, and I was always told as a female, my mom always said, never rely on anybody else for your income. And my dad started his own companies. And so I had those two things in my head. And I remember being in graduate school looking at my student loan debt and realizing that the job that I wanted was going to take me something like 25 years of just paying back student loan debt. And to me, that was unacceptable. So I started a company, and I didn't know what I was doing. And I did have the guidance of my father. But I, by and large, I financed the first business from cash advances from the ATM machine off of my credit cards. So I really learned from the school of hard knocks. And luckily for me, and I do mean luckily, that first company was a success. And then the next two, not so much. And because I failed twice and had one success, I didn't really understand what I had done wrong. And I became interested in entrepreneurship as almost as I wanted to start another company, and I didn't. And I wanted to learn. And so I got involved in accelerators and incubators because I had envisioned myself starting another company, and I didn't want to have a third failure. And that's kind of when I got into investing, really. And so I would say that my path in was a little bit, a lot of people will go out and they'll start a company, and then they'll have a big cash windfall, and then they can start investing some of that money. That wasn't my path in. My path in was more of a wanting to get better and improve, and kind of got pulled along onto the venture path from there. So I was, arguably person one or person two at Techstars. There's some debate on that, depending on what you want to call a person, full-time, part-time, all that stuff. But I was a little bit in the right place at the right time to kind of get this experience under my belt, and I got kind of pulled along into it, right? I would actually say that I think that my background as an operator has been a strength, because if you come up through the venture route, if you start as a principal and then you work your way to associate, you're really trained on how to judge and how to be a judge. And an operator is really trained on how to solve problems. Right. And I like that orientation better. I want to understand how to solve problems with my portfolio companies. I know that they're going to I know every single one of them is going to come across death multiple times in its life cycle. And I want to be as a partner with them, helping them figure it out, rather than being the voice in their ear going, this sucks, this sucks, this sucks. And a lot of VCs do that because honestly, like, they're trained from an early time period to just be the judge. It's working well, it's not working well. What's the opportunity? I don't know. I can't see it. I think it sucks. So I like that orientation better. And I would say that if you wanted to get into VC, my opinion is the better path, not the easier path, but the better path is through the operator route, because you will be more empathetic to what your companies are going through. You will also really understand the value of the money you are managing. It is amazing the different kinds of decisions that you make when you're managing somebody else's money versus when you're managing your own money.
Good point.
So your own money to work, it's a much different approach. And so it's definitely the harder route to go through the entrepreneurial route, but it's in my opinion a better one.
Yeah, and as you think about it in the venture fund, venture capital world, we talk about pattern matching, right? You've seen thousands of deals, thousands of term sheets, and so you have this benefit of this corpus of deals you've seen and the pattern matching, but coupling that with your operator experience can be a real superpower. So I'm sure when you speak to founders, you speak with a different voice. You speak from real experience. And when you tell them their idea is terrible, or you're yelling at them because, whatever the reason is, I don't know, there's just, there's a different background that you're bringing to that. And I want to think about that a little bit more, actually, and carry this into the dynamic of something I know that is on a lot of our participants' minds, which is, well, especially for the years now that you've been in venture and you're, in board meetings, you're in investor, in investment meetings and whatnot. And I'm assuming oftentimes you're the only female in the room. And I just love to talk about that because we know it's a male-dominated industry, at least until now. Hopefully change is coming. But what have you learned along the way that has helped you be successful, helped you reach top levels like you are today, just from that dynamic, the only female in the room?
Yeah, so it's funny. I get asked questions like that a lot, and while I definitely notice that dynamic, I tend to not dwell on it. And I'll tell you why. Like, I'm never going to, like, my gender is my gender. I identify as a female. I am a female. That's never changing for me. And that's not something I am going to change in the future. And so calling out maybe challenges that I've experienced because of my gender is limiting my own potential and my own growth. So what I would say is, when I'm the only female in the room and I feel like I might not be being heard or being understood, once I get over the initial fury of that, because we've all experienced it, right? I step back and I go, okay, how am I showing up? How am I phrasing a sentence that is making it difficult to be heard? In what way am I presenting the information that is causing the receiver to not absorb it? And if I can start there, then I can always improve myself, rather than go, hey, my limiting factor is my gender. I'm in a male-dominated world. And I've always taken that approach. And I actually believe that approach has been a strong reason why I have gotten to where I've gotten, is because I'm not taking a victim approach in this. I'm taking I'm in charge of what happens to me, and I will fix the situation to work for me. That being said, I often think that being the only female in the room is an advantage, because on a handful of levels, right? I have seen very contentious rooms where the guys are getting at each other because their ego is getting inflamed. And I won't inflame. I can inflame, but I won't often inflame an ego, because they don't see me as competition. And so I think that oftentimes that can be a huge benefit, is a female energy can really calm a room down, or can keep people from just trying to win rather than be right.
Interesting. And I wonder, does it change if you're the oldest in the room, or if you're the youngest in the room? Does it change if you know you're the most subject matter expert because it's a particular company that was in an industry that you were an operator in, versus maybe the opposite? You're totally not the most subject matter expert. Do those dynamics matter at all?
I mean, I think those dynamics matter regardless of gender. I mean, if you're the only, if you feel like you're the dumbest person in the room on a topic, does that inhibit you from speaking up? Maybe
Gotcha.
women a little bit more than men. But, one of the things that, like, it's actually, it's an insightful question, and I'll tell you why. So one of the things that we train the Techstars companies when they're going through the accelerator program is when you have people that are in position of authority, and you ask them a question, they will often answer the question even if they don't know, because you have put them in this position of authority. And so what you always want to do is find out the source, like, so when did you experience that? What were the circumstances that you experienced it? What was the context that you experienced it in? That way you can help detect bullshit, right? And I feel that way here too. If I really am the dumbest person in the room and I don't know, I will listen mostly. And on occasion, I will raise my hands and say, hey, I don't have a lot of direct experience with this, but my gut says X. And when I use those kind of words, oftentimes it helps encourage the other people in the room to also say, hey, I also don't have direct experience in this, but my gut says X, to help people know to help people self-identify when they're bullshitting or not. When they stick strongly held opinions as fact because they're in a position of authority rather than actually coming at it from experience.
That's great.
I think just like showing up the way I want others to show up, and trying to set that example, but also just being aware of the dynamics that are in the room. Like a lot of times the most vocal person has the least idea. And sometimes the most vocal person actually does have the most idea, and you have to try to sniff that out. And as an individual, not be rebelling against the situation, but using your own intellect to determine what you're going to listen to versus what you're not going to listen to.
And so as you're in a room as an investor, and a female fundraiser is coming in, and they're making a pitch or whatever it happens to be, are there some common, I'll just call it common mistakes, things that kind of make you cringe? As a fellow woman, you want to be able to pause the meeting and pull this female fundraiser aside and give some coaching. Like, what are some of the tips that our participants could walk away with?
Yeah, that's a good one. So I have a background in sports psychology. Like, I got my master's degree in sports psych, and my undergrad was in psychology. But one of the things that you learn in those situations is that when you're trying to communicate, so the communication happens at the ear of the receiver, not at the mouth of the speaker. And in order to best connect with a person that you're trying to communicate with, in theory, you want to closely closely represent them as much as you can. You want to look like them, you want to act like them, you want to talk like them. That doesn't necessarily mean that you're being inauthentic. But if your goal is to be heard, then trying to show up as much of a mirror as you can to the other person can be very valuable. So the couple things that I see women do sometimes that are a little bit cringeworthy is when they show up really different. Like, women sometimes will come in and they'll be angry because, hey, I'm a female and you're going to say no to me because I'm a woman.
Okay.
Like, hey, we haven't even had a conversation yet. You're showing up really angry. And so what that's going to do is make the other person really angry. Okay. Or if they show up really scared, right? And that's going to make the receiver like doubt the confidence of that person, right? And so I think, and by the way, I would say this is true not just of women, but of men. When men show up in that same way, like if they come in angry, I had a meeting a long time ago with a guy that was like, "Oh, you're just another VC." I'm like, okay, so that's cringeworthy. If you're actually asking me for money, then you would want to at least come with us. Like, I'm here, I'm curious, I want to understand. Like, you got to show up in the same way rather than being defensive or offensive. And so for women, I would just say, try to show up in the way that they are. I feel like I saw in one of your questions, Gordon, like how women dress. Do they dress more professionally or not?
Yeah.
Like, be yourself, but be as similar to that person as what is inside of your authentic presentation of yourself. Because that person will feel safe with you. And that's not just true in fundraising. That's true in every interaction that you ever have. And as a founder, that's what you're trying to do. So
yeah, I have observed, I think, that women tend to dress considerably more professionally than their male counterparts. But I usually perceive it as it's the way that they're dressing that they feel most confident, most professional, most business-like, and not as much trying to fake it. But I do notice the difference. Do you notice the difference in that? And do you, as long as it's authentic, I guess that's what you were saying, is if that's the way they dress that they feel most professional, then that's the way they should come in, right?
Yeah, I would say you want to dress the way that's going to make you feel most confident and professional. Maybe I don't know that that's the word I would use. I would say the word dress the way that makes you feel most powerful and confident. Powerful,
confident. Yeah, those are much better adjectives.
Because like sometimes I want to be in a t-shirt and jeans, and you know what? That's when I feel most confident. And other times I want to look cute and I want to look sassy, and that's when I feel most confident. And if I can come in presenting in that way, then the person on the receiving end will feel that.
Okay,
right?
interesting.
So,
thank you.
But operating inside of a realm, like if you show up in an evening gown,
yeah,
just as unusual as if a guy showed up in a tuxedo.
Yeah.
That might make them feel most confident, right? And so there is like sort of there's social acceptability in that. And as long as you're acting inside of those social norms, then you're okay.
That's great. Thank you. Here's one that I've heard about, and I'd love your perspective. Female fundraiser is the CEO, which means she is the chief fundraiser, has a badass male CTO. Should she bring her badass male CTO to the first meeting with an investor? I've heard stories where if female founder brings co-founder CTO into the room, that the investors will tend to ask that male CTO every question, including the non-product questions. Does that happen? Would you have any recommendations to purposefully leave the CTO, back at the office for that first meeting? Any insights like that?
Yeah, that's a good one. I have also, here you guys can now see that I am a mom and I have an 8-year-old. Anyway, that I've heard stories of that happening too, but it's never happened directly to me. Okay. But I have been in situations where I have been with a male and the person has always looked to him for answers, not to me for answers. And I think the couple ways that you can address that. So first of all, I think you should always, if you have a badass CTO, you absolutely should bring your badass CTO. There's nothing about that says you shouldn't bring it. What you can help do is educate the investor on who's who and what the roles are in the company. And if the investor keeps asking the CTO business related questions when those business related questions should go to you, then I think at some point you go through the meeting, and at the very end of the meeting, you pull the investor aside and you say, hey, listen, I have to ask you a question. Is there something in the way that I showed up that made you direct all of your business related questions to the CTO? Because I am the CEO here. And here's what will happen 9.9 times out of 10. The investor is going to stumble through the answer, and they're never going to make that mistake again. Do not ask the question in an attacking way. Ask the question in a way from feedback, right? And when you do that, it absolutely helps educate and train out there on the best way to handle those situations. And I'm telling you that investor will never do that again.
That's awesome.
It's a beautiful way. But like the other thing is, just make sure that you show up. And when you sit down and you go, this is the CTO, and he handles all of the technology stuff, but I'm the CEO and I handle all of the business stuff, the marketing, the people ops, like whatever all that stuff is. So set it straight to begin with, so that person's got a good foundation. And then the other thing is try not to get angry in the meeting, because that's a sure way to derail the whole conversation, which will then encourage the investor to keep asking the CTO, because every time they interact with you, they're getting right. So that's the trick to that.
That's awesome. Thanks. Yeah. And I've heard that, the two co-founders can help themselves too. So, business question goes to CTO and CTO politely deflects it to, hey, Megan, you're the better one to answer that question. And for that male investor that's just for whatever reason, they're not snapping or they got this bias that they have forgotten about or aren't aware of, even something like that, the co-founders in the interactions and flipping it over to the right person might help early in the meeting is something I've heard some founders do.
Absolutely. But you should bring your CTO. Don't not bring your CTO because you're running into that. I mean, as an investor, investors are investing in teams and they want to meet the whole team. And you've got an opportunity to educate people on the correct way to act in a meeting, right?
That's great. So we've got about 5 more minutes of dialogue while the participants are thinking about some questions that they'll put in the chat line, and we'll get those, and we'll have a good 15 minutes or so for questions that are on the mind of the participants. But it'd be crazy for me to not spend a little bit of time talking about fundraising during a pandemic. At least we're 7 months into it now, and I remember, I was publishing every 2 or 3 weeks to kind of a progressive blog where I'd give additional insights as they became clearer to me during the first 3 or 4 months or so of the pandemic. So we're now 7 months plus past. Companies have adapted as much as they can. Venture funds have adapted and whatnot. Are deals getting done now? Is deal flow back to normal or kind of normal? How would you describe where we are from that perspective?
Yeah, I mean, it's a great time to be an investor. There is a lot of deals happening across the system right now. Mm-hmm. In fact, I saw a statistic recently that said that the number of Q2 deals was higher, or was right about what the number of Q2 deals were last year.
A year ago.
So we saw, and if you can imagine that for a moment, there was a brief moment in time, probably 6 or 7 weeks, where all deals came to a screeching halt.
Yeah.
And so that means that out of a quarter, the rest of those deals all got shoved into the back half of that quarter, right? So the velocity is absolutely there. But what I think is happening is that investors are looking harder and harder at sort of balance sheet and strength of the business and unit economics and and growth. If you don't have some of those things, you're going to have a harder time raising. Mm-hmm. But if you do have those things, you're probably in a pretty great spot. There's a lot of liquidity in the market. There's a lot of interest in venture. There's the public markets are still all over the place. So a lot of people are trying to put as much money into alternatives as possible. So lots of deals getting done. But you got to have a strong, solid business in order to do it.
And is it fair to assume that the balance of negotiating power is, still left with the investor? It usually does reside with the investor, but even more so, it's overweighted that the investors are calling more of the shots, valuation haircuts. Are we still living with that, or swinging closer to kind of pre-pandemic?
No, I think we're still. I mean, the most that I've seen is still the balance is with the investor. But I would tell all entrepreneurs out there, the more solid your business, the less likely that's true. Mm-hmm. And so you're relinquishing control to the investors when you don't have a solid business fundamentals, when the growth of the business just isn't there, when that unit economics just aren't there, when the balance sheet strength just isn't there. You're going to have a lot less say in the negotiations of the deal. And the better that you have, the more solid those things are, the more of a say you have. And the most powerful position you can be is when you can walk away from the deal, right? And so making sure that you're really focusing on the basics of the business is really important right now.
And since the meetings are 100% virtual, I'm going to assume that Techstars will write a term sheet, will do due diligence, close a deal virtual only. Is that fair to assume?
So not a good question to ask of us, because we in the follow-on stages, we do not lead deals anymore. We do not write term sheets. But I'm in a group with 25 or so other GPs, and absolutely they're writing term sheets. They're still doing deals virtually. Many of them have done a deal with a company that they've never met face to face before, and I think that makes them nervous. right? But most investors, most venture investors that are investing in the early stage realize that in order for them to be playing the game, they need to be doing those kind of deals without having met somebody face to face. So I think it's harder, but I do think it's happening. And getting good at virtual meetings is part of the trick.
Isn't that the case? I mean, I've really scolded some founders that were reading from a script as they were doing their pitch to an investor, like first pitch meeting. And unless you have a broadcast journalism degree, you are not skilled enough to read a script and have it seem natural, right? And seem exciting and genuine and with passion. And so there are some tips and tricks that I think founders need to learn very quickly in this virtual world to have an effective meeting, because they're being compared against all other business opportunities, and the way the opportunity is presented, at least for that first meeting or two, it means a lot. Are you finding big mistakes in virtual world, like reading from a script or anything like that? Any pet peeves before we flip to we got a couple questions coming in, so after this we'll flip to some questions.
Yeah, I mean, reading from a script, I would actually rather you reschedule the meeting on me. I'd actually rather you say to me, hey, Nicole, I don't feel like I can present the opportunity in a way that I would be proud of right now. Is there any way we could reschedule the meeting for a couple of weeks from now? And then get your shit together. There is no reason to read. Remember, I'm still investing in people, and I need to connect with you in some way. And this is the only way that we're going to do it, is virtually. And if you're reading, oh man, you wouldn't do that in a face-to-face meeting. Why would you do that in a virtual meeting?
Exactly.
So yeah, don't do that one.
Don't do that one, please. Don't do that one. And think about and also think about what's behind you. Think about the lighting. Think about the audio. Good internet connection. Just all those basics, right? Try and have a good experience.
Yeah. I mean, my 8-year-old came in, right? I actually like, one of the things about this virtual world that I like is it has made us all more human. This is my basement, right? Like, we can all get a little bit of a glimpse into each other's lives that just make us a little bit more human. And I'm fine with that stuff. In fact, I love it. When little kids come in, I'm like, oh, who's this? And tell me their name. Because it helps me learn the person better. So don't be afraid of those things. Yeah. But also recognize that I'm one person and that's my opinion, and that the person that's on the other end might not feel that same way. That's
true. But it has brought a personal element to it. Someone asked the question, you and I were talking about the CTO scenario, and you and I speculated that maybe the CEO and CTO kind of having a conversation ahead of time on kind of roles and responsibilities might help. And kind of the question was, do you agree that kind of having that discussion with the CTO ahead of time might address some issues?
I think that's great.
Yeah.
I think that's great. And I would actually take that a step further. I mean, the question really had a gender lens on it, but I would almost take the gender lens off and put on the lens of responsibility. Who's responsible for that thing in the company, and then direct the question to whoever is in the room. And so if it's a COO, the CTO, and the CEO, have an agreement like this person answers that question, this person answers that question, and help each other reinforce that. Because again, what you're doing is you're demonstrating team. So it doesn't have to be through the lens of gender, although you can certainly look at it that way. But help each other redirect towards the area of expertise, right? And that will also help educate the person on the receiving end. But yes, having that conversation in advance is key. And I will actually tell you, as an investor, one of the things I look for is how a team answers questions like that. Is the CEO doing all of the talking? And if somebody asks the CTO a question, the CTO looks at the CEO for permission before they speak. That is identifying a very different dynamic than when the CEO goes, "Hey, let me let Bob here answer that question," or when Bob says, "Hey, I can answer that because I spend all day doing that," right? And I look for those kind of dynamics as I'm trying to evaluate a team.
I'm really glad you mentioned that, because not only did you point out that CEO, CTO talking about roles and responsibilities within the meeting is just best practice regardless, it also happens to give them a tool for that scenario where male investors are directing all the questions to the CTO, right? So it kills two birds with one stone. But you also mentioned something that I want the participants to understand, that what we do as venture funds, as venture capitalists, sometimes we're purposefully asking questions to try and figure out the dynamics between multiple co-founders, right? And I won't say that I purposely try to pick a fight, but I will try and see if I can get something that will cause an interaction, or I'll purposefully ask the wrong person a question to see how the handoff happens. And I am sometimes looking for that overly dominant CEO when you've got two other co-founders that are badasses, and are they working as a team as they're coming across as a team? So I'm glad you gave that highlight, and it's something for founders to understand.
Yeah, I do that almost every meeting.
Yeah.
Right.
Yeah.
I mean, it's the team. And when you're investing in startups, like 65% of startups fail because of founder issues. And if you really understand that, then you can start to understand that we're trying to identify the dynamic between the founders and what the strengths are and what the weaknesses are, and how they deal with overlap of strengths, and how they deal with the gap in weaknesses. And like all of that stuff is stuff that I'm trying to dig on. And so you as a female CEO or a female CTO might be perceiving that there's a gender question going on, but that's actually not what's happening at all. Yep. And so you have to be careful about going into meetings wearing those lenses and assuming best intentions. And when you can assume best intentions, then you can usually help educate the person pretty quickly on best practices there. So
that's awesome. Yeah, I refer to it as co-founder funk. And I'm definitely trying to figure out if there's any co-founder funk that exists, because it takes down so many good companies.
There's always co-founder funk.
We had a question come in that talked about any noticeable changes kind of post-COVID effect. Are founders growing slower to try and get to profitability? Are they raising less money, more money? I don't know. Are there any kind of like obvious differences now with the way companies are started and getting off the ground versus 9 months or a year ago?
Yeah, I feel like my answer to that question is going to be more empirical than data driven. Just a handful of companies that I work more closely with, I would tell you that everyone is studying the bank accounts closely and figuring out how they can get as far as they can on the least amount of money possible. And so, and by the way, that's just a good business practice all the time, not just before you're profitable, but even after you're profitable. It's just harder to do when you've got $5 or $10 million in the bank and you're thinking, oh, I've got 18 months of runway, or I've got 20 months of runway. So I would just say that a lot of companies are really looking at how much they're spending and versus the output from that spend. And so it's not just about how much am I spending, but it's about the output of that spend and what am I getting for that spend, and am I getting closer to profitability or break even? Am I able to weather the whole COVID storm? I mean, I still think we're 18 months away from it, being somewhat more normal. And so I see that as a trend, really studying the bottom line and figuring out what levers people can pull. But I'm looking for that because I think that that's a best practice. So.
And are you advising a lot of companies, including your portfolio companies, that when they raise, that they should raise enough to last? You said you still see this kind of having some effect on us for 18 months, or are you recommending that they might raise enough to get more runway than you would have a year ago for that reason?
Yeah, I mean, I think the lack of knowledge on what the future holds, that is creating some amount of instability. And I absolutely think that right now, if you have an opportunity to raise, you should raise, and you should try to be as conservative as you can with that cash, and think about So I feel a little funny saying think about 18 or 24 months, because prior to this, prior to COVID, I would always tell companies, I don't care the time period. What I care about is what you're accomplishing in that time period. So don't talk to me about months, talk to me about milestones.
Yes.
And I still feel that way. However, because of the instability of the pandemic and the markets, I've layered in a month thing in there. I can't say that in 18 or 24 months it's going to be great, but at least if you've got some milestones built in there that allow you some decision points, like could you get to break even? Or that's a really good milestone to target right now, because we don't know what the future looks like. And then when the future starts to become a little bit clearer, you can step on the gas more. So
that's great. So in other words, they might have a path to break even or profitable. It doesn't mean they have to actually execute that, but being on that path as we get, 9 months or 12 months into the future and it becomes clearer, they could either stay on that path to get profitable, or if it looks like they've got opportunity for escape velocity, they could shift a gear and go for it, right? But at least they would have that option if they set down that path now, huh?
Yep. But I would say that there are exceptions to that, right? The exceptions are if the business is working and it's all just growth, then I would say, and you've got some tailwind from what's going on in the market, then I would say pour fuel on the fire.
Right.
Because there is a lot of VC capital right now that it's available. And so, you have to balance with what's going on in the business and different. There is no blanket rule for all companies. You got to sit down and figure out what is best for that particular company and help them get there. For some, I'm like, you have only one milestone right now, and it's break even, because you are not going to be able to raise. Your business took a huge hit. You're burning way too much money, right? Your revenue tanked. Your balance sheet's dwindling. No investor is going to fund the business right now. So let's get you on a path to break even. And other companies, you're like, go grow. It just depends on the company.
That's great. And, you mentioned something that there's been a couple questions regarding the COVID, what I call the COVID pivot. And, most companies, there are some that were advantaged because they just happened to be in a sector that was advantaged by the COVID effect, right? Everybody else, like 90% of other companies, evaluated and many executed some version of a COVID pivot. How are you thinking about those? Like, can you just pivot into being advantaged by the coronavirus and then, I don't know, keep it that way? Or how do you figure out, is it going to last, or is this just like a temporary thing that's going to go away as soon as we're back to normal?
I mean, that's hard to tell, right? Like, I'm close to a company that does mortgages, and of course they saw like mortgage refi rates spike because interest rates were so low. And is that COVID? And by the way, also people are realizing that they can move. They don't have to live where their company is. They can telecommute. So there's a lot of people moving right now.
Yep.
And so you go, okay, well, what percentage of that is COVID versus what percentage of that is not COVID? And how do you think about that? And so what you can just do is like look historically at when interest rates were low, what was the percentage increase in mortgage refis versus new home purchases? And where does that put us now? And then the difference between those two things you can attribute to COVID. So let's take that off and see, does the business still work moving forward? But then you also have a like, hey, I got an opportunity to capture some market share, so maybe I should grow. Like, there's not a universal way of thinking about it. It really is per business and per sector. But I say to the founders that, hey, some of them, their companies weren't working before COVID. Because of COVID basically killed the potential of the business. But hey, maybe that was good because it wasn't working before.
Yeah.
They have pivoted into something that kind of is now working, and like, go run, like, see if you can take advantage of it, because maybe you can actually build a business that will sustain after COVID is too. So.
Yeah. And I find myself getting kind of excited in a way, thinking about what the world's going to be like a year and a half from now, because enough things are going to be different but different, I think, in an exciting way. And so, we'll see what all that's about. We need to wrap here. I want to do a couple things. One, I want to let the participants know that I'm running my quarterly Founders Academy bootcamp next week. It's a 3-day lunch and learn. And you can get information on that at foundersacademy.eventbrite.com, foundersacademy.eventbrite.com. And Nicole, I was also wondering if you'd be willing to share with our audience, I don't know, either a favorite blog that you follow, favorite podcast that you're listening to, or a favorite book that you've read recently. I don't know, anything, especially anything that kind of relates to the topic we've talked about, or something that you would think would help the participants at this Women in Tech Summit. Anything jump out?
Yeah, that's a hard one. I read a ton. I don't actually do a lot of blog reading or podcasts. I tend to love books, and I read probably 2 to 3 books a week. I did just binge on all of Brene Brown stuff because I had never read any of her stuff before, and I like literally read every single book in a month. And so she comes to mind because I just binged on everything, and I love her, and I think that everything that she talks about is super applicable to our industry, even though she doesn't talk in those terms. And then I had also mentioned that we are heavily influenced by John Bogle, who is the founder of Vanguard. And I highly recommend his book that's called Enough. And it's something that it's a theme for me recently on like when is enough and enough. And we live in such a consumeristic society. And the interesting thing that happened with COVID is that people kind of realize that they could actually consume less, and then they could do less, and they could interact with fewer people, and everything could be less, and it would still be okay. And so the concept of enough is something that John Bogle talks about in that book Enough, and then also Lynn Twist wrote a book called The Soul of Money, which I highly recommend that book. But maybe the couple that come to mind that have been
Soul of Money. Thank you. I appreciate that. Of course, we really appreciate the contributions that Brad Feld has made with all of his publishings. Your colleague, Amos Schwartzfarb, last year wrote a book. He and I both published books last year. His was on selling, Sell More Faster, I believe is the title of his book, reached a bestseller list. I could highly recommend Amos's book called Sell More Faster. And then I published a book on early stage fundraising. So he and I had a good time comparing notes along the way. So we really, really, really appreciate your time with us, Nicole. Best of success with your fund. And when the days get that we can jump back on airplanes and you find yourself in Texas, find yourself in Austin, we'd love to host you at Capital Factory.
I would love to come. Thank you so much for your time, Gordon.
Thank you. Likewise.
That was really, really informative. I would expect that, Nicole, you're probably going to have about 200 new social media followers. Great information. I guess John Vogel, read the book Enough is a really good starting point. And just talk about badass. I mean, Nicole, hashtag badass. Very, very fantastic information. So we are now moving on to another fun event. This is going to be our startup showcase. So it will be a pitch competition, and we're very excited. We have a esteemed panel of judges, and it's a really amazing prize package as well. So the prize package is inclusive of $10K in legal services from BakerBots, a guaranteed investment meeting with both Silverton Partners and True Wealth Ventures, and a mentor meeting with Jim Breyer, founder of Breyer Capital. So Monica is I'll call her the Capital Factory liaison for startups, and she's going to help us run the showcase. So I don't know why I said Monica, I meant Morgan. If you could help us introduce our judges. Thanks, Morgan.
Unmute myself. Hi, yeah, so my name is Morgan. I work on the accelerator team over at Capital Factory. So I want to welcome you guys all to this Women in Tech Startup Showcase, where we're going to be featuring 4 of our portfolio founders today. They are from across the state of Texas, and we're really excited to showcase some of their technologies with you guys today. But before we get started, I do want to call up our judges so they can introduce themselves and say hello to everyone. Hey guys, so let's start with Jim. If you want to do a quick intro of yourself.
Hi everyone, I'm the founder and CEO of Breyer Capital, which is a venture capital family office here in Austin that I founded. Previously, I was the managing partner of Accel Partners in Palo Alto and Menlo Park for 28 years. Perhaps most notably leading the Series A in Facebook in 2005 when Mark Zuckerberg was not yet 21. Great to be with you all.
Awesome, thanks Jim, welcome. And Carrie, let's kick it over to you if you want to introduce yourself.
Sure, hi, I'm Carrie Rupp. I'm one of 2 partners at True Wealth Ventures based in Austin. We are a small seed stage fund focused specifically on women-led companies. So I'm sure many of you in the audience know us already, given that we're in Texas and focusing on companies like you, we specifically are an impact fund focused on companies that are improving human and or environmental health. So a lot of times people get told you have to talk to Carrie and Sarah, but we only focus on those two sectors right now with our fund. But we spend a lot of time obviously trying to support women entrepreneurs around the state and more broadly. So excited to be here today.
Awesome. Welcome, Carrie. And then last but not least, Molly, if you want to give yourself an intro.
Sure. Hi, everyone. I'm Molly Duckworth. I am a corporate lawyer with Baker Botts here in Austin. Baker Botts is an international law firm. We have about 14 offices around the world. But here in Austin locally, we have 85 lawyers who are providing legal advice on everything from financing transactions when you're looking to raise money from investors to just like everyday corporate governance, employee benefit matters, litigation when you have disputes that come up, and importantly, intellectual property matters to help you protect your ideas and the technology that you've created. So I have the great fortune of serving as the partner in charge here in Austin. And so I'm representing us today. We've been a partner with Capital Factory for a couple of years now on the Innovation Council. And one of the best things about getting to be involved with Capital Factory is the opportunity to meet entrepreneurs, just like all of you. So I'm really thrilled to be here to support women in tech and can't wait to hear everybody's presentations.
Awesome. Thank you guys so much for being here. So let's get started with Brittany with Accelerist to kind of kick us off with the pitches.
Hi there. Thanks, you guys. I'm going to share my screen and hopefully it works. Okay. Is it coming through? Is that a thumbs up or no? Okay. Yep, I can see it. Okay. So hopefully you can hear me as well. I am Brittany Hill. I am the CEO and founder of a company called Accelerist. We are a social impact SaaS solution that helps nonprofits in particular prospect, price, and prove ROI to their corporate supporters in half the time and for 80% less cost than competitors. I have spent my entire career at the intersection of profit and purpose. As a 15-year veteran, I formerly owned an award-winning social good consultancy that specialized in helping blue-chip nonprofits and Fortune 1000 companies work better together. But after that experience, I realized that 1.7 million nonprofits in the US still have challenges finding and keeping their corporate donors. They spend about $61 billion on software every year to help them raise more money, yet most of those solutions support individual and peer fundraising, and only a few actually even tap the surface of corporate donations. Meanwhile, as you can see here, corporate philanthropy has grown by 15% year over year over the last 2 years, actually outpacing individual giving 5-to-1. With a more competitive market and increasing pressure from investors like BlackRock and State Street, companies are required now to prove the return on investment that their impact investments are having, not only on the community, but on their bottom line. And unfortunately, nonprofits like our customers, the Alzheimer's Association, Mayo Clinic, Susan G. Komen, UNICEF, and so many more are left ill-equipped. However, we've also seen this, the importance of profit and purpose partnerships become much more important during the time of COVID, with corporate giving having accounted for nearly 2/3 of COVID-19 philanthropic funding, and that's almost $8 billion this year alone being given to nonprofit and social issues. Historically, we also see coming out of the recessions that nonprofits have to do more with less, and so their tech investments also spike. With that being said, we know that we have proven traction. And over the last 4 years, you can see we've evolved into what we call a partnership intelligence platform. We have 3 products that are part of our platform. We help them find new partners, new qualified partners faster. We help them price opportunities so they understand how much they can command from corporate America. And since 85% of a nonprofit's portfolio is made up of recurring revenue, we help them measure the efficacy of their partnerships and prove the impact of those investments on the community, their constituents, and their bottom line. So with the help of a stellar team and stellar advisors that range from experts across social impact to tech to B2B experts, we've supported over 100 different enterprise customers. Over the course of the last few years, we have seen an increase in those funds raised for our nonprofit customers by 30% after they've gone through our system. We've witnessed this growth because we believe that the combination of our expertise, our custom IP that specifically addresses customer need, while also serving as this aggregate solution for all of the needs mentioned here for 80% less cost. You can see that we can accomplish a lot and can accomplish more for 80% less. Our average price per customer is $25,000, whereas a normal nonprofit would have to invest over $125,000 a year to accomplish what we can for them. Our customer acquisition costs are low. Our customer lifetime value is high at 2.5 years. And we've seen a lot of success in leveraging content marketing and our thought leadership. We do have a typical SaaS model. We closed last year at revenue at $1 million in revenue. And I'm happy to report, as of last week alone, we just received a term sheet on our post-seed raise from a lead investor. So we've closed right now about $715,000 on our current post-seed raise at a $3.5 million pre-money. And that is on a total raise of about 1.2, although we might go ahead and roll that in, close that out early. We hope to double our customer base with this use of funds, support our R&D scale, continue to scale our sales team and our marketing to reach profitability over the next 12 months. We believe in what we're doing. We're extremely encouraged by our traction, and we're ready to scale to make an even greater impact on our world. Thank you so much. Are there any questions? Oh, I can't hear anyone. There we go.
Right. We're up. All right, let's kick it over to our judges for some Q&A.
I can jump in. Hi, Brittany, this is Carrie. You mentioned that you're charging 80% less than what competitors charge. And I guess I must be a real capitalist, because that triggers to me a question about whether or not you're leaving money on the table. So I thought it might be helpful. You could also roll into that answer, who the competitors are and how you're differentiating, but why you also feel like you need to be so much priced so much lower if you're not capturing all the value that you might be able to capture from your customers.
Absolutely. We have received that feedback before. And so we are 80% less. Our current competitors in the market range from the Hoovers, Winmos, ZoomInfos of the world when it comes to intelligence and databases. But then we're also competing with the only other solutions in the marketplace, which are consultants and consultancies, which charge 6 figures sometimes or more to do the same job that we can. So we are, in some instances, that first tech solution that, as we all know, creates extreme cost efficiency in the space, which is why we can charge so much less. We do think that we have a little room for growth, maybe in terms of increasing pricing over the next couple of years once we can scale and resume adoption or continue adoption. We do scale all of our price points based off of the annual contributions and revenue of the organization so that it is economical. So our price points range from $4,500 a year for an annual membership to $45,000 a year. And that's where our average price is coming at, about 25.
Brittany, could you tell us a little more about how you segment your customer base? You have a list of terrific names, Mayo Clinic, Cornell, others. Are there certain pockets of nonprofits that you feel are more amenable to what you're doing than others as you segment the market and get more focused on very specific segments?
Yeah, so we currently support, we call enterprise nonprofits, or qualify that at anyone raising $20 million or more per year. We see a sweet spot at about 50 to 100 is the revenue, because they have a legitimate corporate portfolio already that really both of our areas of our platform can speak to. Where we see a lot of scale in terms of additional corporate vertical or customer verticals on the nonprofit side is in the healthcare, hospital and healthcare space. So more Mayo Clinics of the world, more MD Andersons of the world, and then also higher education academic institutions like the Cornell universities. And so that's where we see a lot of growth there. And then of course, with our new use of funds, we've been beta testing, replicating our existing product for the corporate customer vertical. So exactly the inverse, and helping companies identify social issues that they care about and which community and nonprofit partners are right fit for them.
Terrific, thank you.
Mm-hmm. Brittany, you mentioned as one of your goals in going forward as moving into other industries as well and expanding. So you mentioned both healthcare and higher education. Are there other industries that are on the horizon, or just kind of tell us a little bit more about your growth plan?
Well, we're seeing a lot on the nonprofit side. What's been really interesting with COVID is while a lot of federated nonprofits that we work with, and by that we mean chapter-based, so the Comans, the Boys and Girls Clubs, the Big Brothers, have laid off 60% in some cases of their workforce. We've seen other organizations like those that are focused on racial inequalities, those that are focused on food insecurity, those that are focused on social issues that have a greater sense of urgency right now, really turn to the corporate sector like they never have before and start a corporate partnership portfolio. So that's where we see a lot of growth in terms of nonprofit in the immediate future. But what we really focused on in 2021 is building out, again, that corporate vertical. So right now, our primary customer is the nonprofit. We're looking to sort of mid-market customers that we've been beta testing with brands like Harry's, Seven for All Mankind, Burger King, Popeyes, that mid-market kind of company that really needs to redefine what they stand for or define what they stand for so they can be a purpose-driven brand.
Okay, awesome. Thank you so much, Brittany. That brings us to time. Thank you, judges. And let's get Ari brought up so we can get ready for our second pitch.
Awesome, Morgan. Thank you so much. Can you see my screen now? All right. Looks like we've got it. Fantastic. Thank you all so much. It's such a treat to be with you all here today. My name is Ari Palmer, and I'm the co-founder and CEO of TaxTaker. We're headquartered right here in Austin, Texas, and we help startups apply for and secure the government's #1 non-dilutive funding program for innovative companies, the Research and Development Tax Credit. R&D tax credits are our government's way of rewarding companies with tax relief for their development efforts so that they can continue to hire, grow, and scale. And while businesses nationwide claim upwards of $12 billion annually, it's actually estimated that over 90% of eligible companies miss out on their share. And startups miss out the most, leaving billions of dollars on the table unspoken for every single year. So with the fundraising climate uncertain as ever, especially for early stage companies, it's a challenge to secure funding and fuel business growth. And startups, they just need all the resources that they can get. So alternative funding has really skyrocketed, and though we know that startups still are overlooked and grossly underserved. So most of us also don't get into business thinking about our accounting, let alone our taxes. But that ends up costing businesses a ton of money, and we think that's a problem. So that's why TaxTaker matters, because most likely your startup could be leaving a lot of money on the ground, and we have a product that turns that waste into recurring revenue. So at TaxTaker, we identify, apply, and secure R&D funding for early stage through growth stage companies. And if you're thinking, I'm hearing tax, but I don't pay taxes, you're not alone. But I urge you to think again. This program actually allows for unprofitable or pre-revenue companies to use this funding as a payroll offset, effectively boosting cash flow, by over 6% every year. So how can we possibly do this? So when we engage with a startup founder, They spend about an hour in total to provide us with financial and project information. And in turn, we turn around an average first-year refund of $43,000. It's no small change and a fairly simple process to go through once we identify just the key pieces of information that we need to gather from the company. Our business model is very simple and it's zero risk for the startup. We work completely on a success-based fee model. We only charge 15% of the findings if we successfully deliver. And if we don't, you owe nothing. Since launching just a year ago, we've successfully processed over 100 claims and proudly secured over $5 million back to startups' pockets. We attribute most of our customer acquisition success to partnering with accelerators like Capital Factory, GAN, Techstars, as well as VC and accounting partners across the country. We did not expect for the pandemic to be a catalyst for so many companies looking for government funding. But nevertheless, here we are. And so that really was a catalyst for our own huge growth spike. And we're really happy that we can help support businesses more than ever during these times. We're actually on track to do 500% year-over-year growth. Because of this, we recently raised a seed round. We oversubscribed 500,000 to 750,000 so that we could go ahead and execute on our product roadmap and better serve our client savings initiatives. We recently rolled out a supplemental state offering and several integrations that are already part of our customers' tech stack so that we can further speed up the process and identify additional savings. So our plan really is to be your one-stop shop for all things business savings, but we really need your help to educate the market and build the megaphone around this opportunity. So my ask for you today is, if you are a startup, you invest in startups, work with startups, or just know a startup, we want to meet you. We have a special link for Austin Startup Week attendees, so you can check with us to see what you might be leaving on the table. And so it's your money. Come take it with TaxTaker. Thank you.
Cool. Thank you, Ari. All right, judges, we have you up. I think we're waiting on Molly.
There we are.
Cool. Carrie.
We lost Ari. Ari, I have a quick clarifying question, which, and then I have another question if that's a fast answer. But when you said at the beginning of an onboarding with a startup, you spend about an hour gathering all this data. Is that actually like a consulting services kind of thing, or is it them on the data platform? Like, so how much of it is a services model versus a product model?
Yeah, so it's a mix of a services and a platform. We right now, to date, we've always spoken with the startup prior to them being onboarded onto the platform. That typically takes 10 minutes to do. So that's kind of the services component. And then they go through an automated experience, kind of like that of a TurboTax, but they do have some hand holding along the way with our CPAs and engineers, which we found that they like to be able to call upon a human if needed. But as far as information gathering and connecting the data, that's all through our software platform.
Okay, when you talked about integrations, that could be, for example, downloading info from their accounting system so they don't have to manually re-enter it, et cetera.
That's right, exactly. So that's going into QBO, Xero. Also, we're launching new payroll integrations like their Gusto. That's also going to be able to allow us to have a more real-time kind of tracking of where their credit's going to land.
Great. Okay. I have other questions, but I'll let the other judges jump in for a second.
Ari, terrific presentation. Question, as the startups grow, what kind of relationship do you anticipate having with the startups, the boards, as they continue to grow over the next couple of years?
Yeah, so we really want to grow with the company. Our team is, I didn't actually get that much time to talk about our team, but all of us have been actually R&D tax credit nerds for the last decade plus. And we found that we're able to get stickiness really with these startups as they grow, especially since once we work with them once, it gets easier every year to kind of come back and do a re-up of their findings. And we fit really nicely with the boards and their accountants as they grow too, because we play nicely in the sandbox. We're really kind of just this one item for them year long.
Thank you.
Yeah.
And so picking up on, I guess, the point about it being, just this once, but you start with the R&D tax credit. Can you tell us a little bit more about kind of what are the areas for growth? And you have competitors, what does the competitive landscape look like for taking those next steps?
Yeah, sure. So we're really excited about the other savings opportunities that we can present to these companies. We're seeing a big push through economic development departments, as well as other types of grants, both public and private. And we start to see those trends already that we're already putting to our clients' attention manually. So we're really excited to be able to offer that in application. It's actually funny. One of the biggest questions we get even before a company signs on with us is, what else, right? Because they're so surprised that we're able to bring them this much value on an annual basis. So they say, there must be other areas in which you can help us. So that's why we've issued the state rollout. And then we've been identifying kind of these other savings opportunities by locality, region, industry, size of company, et cetera.
Awesome. Thanks, Ari. And then Carrie, you had mentioned you had another question if you want to
So I think their channels are obviously make a lot of sense. And as a VC fund, I could see offering this to my companies, but I'm worried about how you get scale beyond those channels, especially in terms of repeated engagement. I'll remember to mention it today to them, but maybe next year when I bring on new portfolio companies, I may forget. So what are your thoughts around how you're going to do acquisition, customer acquisition at scale?
Yeah, absolutely. So we're definitely going to have dedicated kind of account type managers for those strategic partnerships. But we really found that our customers can be our biggest advocates and biggest mouthpieces. No startups, no other startups. They're communicating in these Slack channels through their portfolio companies. These accelerators are constantly putting, educational resources and events. So we can kind of duplicate ourselves through those efforts as long as we kind of stay in the mix and make sure that we're still present. But we're really most excited about our customer loyalty. They have really been the fundamental kind of catalyst in addition to the channels that we already have.
Great. Thanks.
Awesome. Thank you, guys. And that brings us to time. So we can pull our judges down and we'll get Monica. She'll be on deck for our next pitch. Hi, Monica. Oh, you're muted. Want to unmute yourself? Perfect.
Okay, so should I go ahead and share the screen?
Yeah, share your screen. And if you could turn, the audio might be a little bit low. Maybe that's on my end.
Sorry, it's hard to use a new.
Do you have headphones in?
No, are you still having, is it still having hear me?
Yeah, that's much louder. Perfect. And I see your deck. So let's bring that on. Okay. All set.
All right. Well, hello, I'm Monica Landers. I'm founder and CEO of StoryFit. So it used to be that movie studios and networks and any kind of show producers would spend millions on a show, and then they put it in front of an audience to get feedback, and then they spend millions more to fix it. But these traditional methods just aren't working anymore. There's so much change going on with the industry right now, and so the old methods aren't cost effective, and frankly, they're not always right. So now with StoryFit, we have a way to give them this information before they spend all this money. And that's because we've delivered an entirely new data set. So if you can imagine in other industries, you don't come up with new data sets, right? This is data that you expect. It's all ways of managing. But these companies have never had data on their most crucial and important asset, which is their IP. So we're now able to measure everything that makes a story a story. So we measure items like the genre and the pacing, the intensity, the emotion. We know information about the characters, and we can tie that all to future audience success. So why does this matter? Right now in the industry, it's huge growth. 2020 is a bit crazy, but if we just take the numbers from 2017 to 2019, these large media companies have more than doubled their annual content spend. So they're spending more and more money, and that's expected to continue. So it really is an arms race. But where all of this is based on is down to the very beginning nugget, which is the story itself. So the challenges that we see here is that despite all of this money that's being spent, 65% of the time, and sometimes more depending on where you measure it, it's a flop. So it just doesn't work. And on top of that, now we have this increasing platform distribution, huge competition with new platforms emerging, as well as some media consolidation. So basically, there's no one that wouldn't say we need to find new techniques for this, and that's what StoryFit answers. It is a new way, new data points to make smarter decisions. So for an example of how this works, if you're able to now measure all of this information about different movies and films and TV, we can offer comps. And comps, for the first time ever, can be based on actual story data. This is the core to how these companies make decisions, how they determine spend, and how they find their audience. And we're able to drill down on every single movie, not just the ones that you can think of in your head, but the information on every single movie that has ever been made. So this is a huge bit of information that didn't exist before. So that allows them to go much faster. And what used to take months can now take just a couple of days to review. A couple of the other things we do, because I think visually sometimes it's hard to imagine the data that we deliver, is we're able to visualize character networks, for example. So this is the way all the characters relate. And it turns out it's very predictive for future success depending on the genre. And this is all information that we have that we're able to deliver. And when we measure the characters, we're able to measure more than 350 individual character traits. So our models are actually more accurate than one person could do in analyzing any of this data. And so that's something that we're able to bring to the table that in the past, they just couldn't even ask these questions. So the way we use this is to make comparisons not only of the film to other films, but also characters. So this is an example of a character comparison for a very new animated character. They were trying to understand what the lead is and how they're going to market and how they're going to talk about this character. So you can imagine, without even knowing the lead character, that you have an idea of what he's like right now. So in this case, he's intelligent, brave, and adventurous, but he's also very modest and cooperative and a lot more mild-tempered than what you might traditionally think of in a character. I meant to mention too on this last one, when you read the characters, I'm not sure, depending on your screen, if you can see, but when we look at the main character on the right, we can see a lot of his strongest traits are the dominant, commanding, attractive, and then also on the bottom, you see the brave, extremely brave, fast, diligent. I mean, this is an action character. On the left, then, is the supporting roles. They get an idea of the dynamics and can compare their relationship even to other current successful relationships. So it allows for conversations that maybe have been happening in rooms that are debates now to be very concrete. We're able to help with SQL because of the amount of data that we can carry. We also can answer these questions about current trends in content development. So we can answer questions by genre and understand where the key points of both dialogue, action, or even violence occur. These companies can also look across entire SBOTs, entire streaming services, to really understand what's happening. So I've gone through these pretty quickly because I know this is an industry that maybe you haven't spent a lot of time in. But if you can imagine an industry that just didn't have this data and did this all manually or off the top of their head or purely by gut, this is a real step forward. So our mission really is to help these global storytellers put their projects in the best position to succeed. And these are some of the companies that we work with, just to give you a cross-section of both really large, studios like Universal and networks like CBS, and also some well-known favorites and mid-size like Braun, who recently did Bombshell and The Joker, and Blumhouse, who did Get Out and is going to release another Halloween movie in a couple weeks. And so this just gives you an overview. I think on the fundraising side, we've closed 3.7 million as a seed round. We'll likely hit our Series A next year. I haven't started raising for that, but we're continuing to grow, and not just kind of the month over month, but also grow within studios to show that once we come in one area, we're able to move within the studio to increase the number of projects that we do. That's it.
Thank you, Monica. So I just totally appreciate how I think we're having an echo, how a company who hasn't had access to this data before gets really excited about, okay, now I want to go build a story that has these characteristics and a main character who has X and Y. But how is that actionable? How does that actually translate into either the script writer or the other production value kind of elements of the story? And can they iterate? Can they like write a script, have a scriptwriter write something, put it in the system and go, uh-oh, we didn't get close to that characteristic, go back and do a rewrite? Like how do they actually take this and actually get the value out of it to make change?
Yeah, and what we've noticed is it's slightly different each time. And that's something that we've learned, even though we built a platform, is that when we deliver it, they have different use cases. And so specifically, they usually tell us what their main concerns are. Anytime we never get something that they feel great about because they just wouldn't use us for that type of script. So there's always some concern, and we specifically address that. So for example, for one of them, they were really concerned that they did a book to movie adaptation. They weren't sure that they were true to the characters, and they were worried about losing 10 years of book audience when they released this television show. We very specifically made that comparison. So their action away from that was 5 characters are great, your one is very different and it's concerning. And so they were able to loop back with marketing and really prepare the existing audience for that. So there's a lot of examples, but they do tend to be diverse and not always the same each time.
Monica, great presentation. Having been on the film side as an investor board member at Marvel Entertainment and Legendary and 21st Century Fox, I've always been perplexed why there aren't more technology companies that find ways to penetrate the studios. Mm-hmm. And so it's something different today, or is that very long, complicated sales cycle still in place?
It's definitely a long, complicated sales cycle. We purposely started with the larger companies because we think that's going to build the credibility, but it definitely is long. I think it's a little bit easier because they're scared to death right now, right? This is really intense, this competition, and they know they need to move fast. So I'd say even in the last couple of years, the conversation is easier. Every so often we run into someone who just says, like, I won't work with technology, but I am seeing that less and less. And most companies that we talk to are fairly open. I mean, I can count it on one hand of groups that have absolutely said we don't want to use technology, period. And I think that's going to be shrinking. So, but you do understand. So I would probably discuss it with you differently because that's definitely kind of the broad description of it all.
Thank you.
Yeah.
And thank you, Monica. I thought this was fascinating. And I'm really curious, not being super involved in this industry. How do you, is there some sort of industry standard, or how do you measure things like setting and tone? And, so that all seems very subjective. And so when you're kind of presenting your data, what is that kind of based against?
So there are lots of types of data, and some is very concrete, like you said, and actually setting is easier to be concrete. We also measure elements like violence, language. I always think of the sex, drugs, and rock and roll measurement to try and give them indications. And we're just very accurate. Like, we're able to predict the MPAA. So part of it is just we have to deliver one and let them see that it's accurate. I think that's the biggest thing that we've done is figured out how to measure that because each time it's different. It's not like you're taking a ruler to every single different trait. Like, pacing has many different elements that are included in it. We're fairly transparent with the studios of how we do that. Not the how, but what it's made up of, so that they can, believe us and work with us. But I think that's one of the hardest things to do. And when we talk to studios who kind of tried this in-house, they're the best to talk to. So they say, this is hard. And when we started working with Amazon Studios, they just thought, surely this exists somewhere. And we had to talk to group after group of even data scientists, and they would just say, oh no, this is hard. Like, we don't do this. And so I think that's where we're captured right now. We really are in the lead. And I think, to Jim's point, the challenge is us to get in there and for studios to get comfortable in working with us, which is a big step.
Thank you.
Awesome. Thank you, Monica. Thank you, judges. That brings us to time. So we'll say goodbye to our judges for now, and we're going to get Tony up here for our last but not least, our last pitch of the day. So if you want to bring up your deck.
There, can you see that?
Yes, Perfect.
Well, I am thrilled to be here. Capital Factory, thank you so much. And I'm really impressed with the 3 other companies that I just listened to. So this is awesome. If you're sitting where I'm sitting and you're looking at what I'm looking at, we're all having an interesting dilemma right now in a really big problem. And by the way, this problem was existing before COVID, but it's here in spades. The first thing was with distributed teams and people working from home or from co-working locations, there was just nowhere to go to be with the community, with colleagues and with clients. And then there was this plethora of tools. There was Slack and Zoom and Skype and GoToMeeting and all the craziness. And we are suffering from what is now very fondly being called Zoom fatigue. In fact, it's real. And how weird is it that we're at Austin Startup Venture Week, and here we are doing this all remotely from our other offices. So I think the best way to show you what we're doing is to take you to my office. We've got now virtual real estate. Prop tech is hot. So I log in, and when I log in, I'm immediately taken to my office. First thing I do is I pull up what we fondly call our heads-up display. And on our heads-up display, I see my colleagues across the office itself. One click of a button, and I'm on full video. And not only am I on full video, but I'm moving my video around, I'm making it bigger. I walk down the hall, and I'm immediately in a very different place with my colleague, Chris. Click of a button on video, and you can see that I have now transported myself from my office into Chris's office. And Chris, hey, welcome. Maybe you could do a quick share screen with me. Now, I am in Colorado somewhere. My colleagues around here have got red circles. That's because their doors are locked. And with the click of a button, I can lock my door. Chris is sharing his screen. I can go full screen on the screen he's sharing. I can escape out of that. I can make Chris bigger. I can move him around the screen. And then if I wanted, I could go down the hall and have a water cooler conversation in the cafe. And when I do that, it allows me to show you a couple of other features that are wicked cool. So this is like prop tech, virtual real estate. I've also got an application console, and it has all of my favorite apps at the touch of a button. And I don't have to log in. I just click them and I'm in. And we've got unbelievable Slack-like chat with a Slack bridge where you can interoperate and leave audio, video, and text chat. So Chris, I'm going to go ahead and mute you there. If you could mute your mic, that would be great. So that's a little bit about Walkabout. So let me take you back through the opportunity that you have as an investor. Now, pre-COVID, this was a ginormous investment opportunity with about $185 billion getting spent in unified communication platforms and video conferencing and team collaboration. But guess what? Post-COVID, I don't think anybody has even been able to size it. And we're on a roll. So we were doing well in ramping distributed teams pre-COVID, but now we've got over 60 clients, over 2,000 users. Our monthly recurring revenue is north of 21,000. And the cool thing is that we're everywhere in the world. We've signed Hitachi in Japan, not only as a client, but as a reseller. And on the heels of Hitachi, we've got NEC, we've got NTT, we've got SoftBank, and we've got Rococo, all not only launching for their work from home employee base, but looking at becoming resellers. We're in the United States and in Europe, we were named number 2 out of 521 companies post-COVID. Our executive team is second to none. This is the 6th startup that I've run, and I fell in love with the platform because it is outstanding in being able to manage businesses and organizations and even schools across the globe. Co-founder and CTO are second to none with multiple startups under their belt. Our pricing, as you might imagine, is very simple, software as a service, and we think we're priced right in this market for both augmenting and replacing tools and technology that are out there, and living with the Zooms of the world, the Microsoft Teams of the world, and coexisting with real estate, where the new norm will be hybrid, both coming to the office and maybe never coming to the office again. A SaaS model becomes very, very profitable, and we believe in the next 12 months, we're going to be a $3 million company and growing off of that. We're in our second capital raise. We raised $1.25 million to date. And by the way, about 600,000 of that has been since May. We're super excited about this round. 58% of our spend will go to tech, another 35% or so to sales and marketing. We know that at about 28,000 users, we get to cash flow break even in month 33 or sooner. We hope that will be EBITDA positive, and then a very lucrative SaaS model. And so I hope that you'll consider investing.
Awesome. Thank you, Tony. Passion shows through as always. Love it.
Yeah, and it was actually great to see the live demo. A lot of times that's risky, but I thought it was really helpful here to really see the ease of use of navigating the office. I'd love to understand, I'm going to steal Jim's question from earlier because I think it's really relevant here, how you segment the market, as you think about which companies are your targets, and maybe tie into that answer just the competitive differentiation specifically because of the needs of that segment. What's particular about that segment's pains?
Super great question. And by the way, everybody needs us. We have prioritized the enterprise markets that we're targeting right now. And we believe enterprise is the right way to do this, to get to scale and to get to profitability. But then we will be doing self-service in SMB as a market. We believe call centers are huge. Imagine being able to see your work at home agents and be able to be up close and personal. We're going into a pilot with Progressive Insurance, who has 40,000 work at home agents. So we're super excited about that. Development teams are next. Onshore, offshore, if you think about connecting the development process. And then, as you obviously observed here, enterprise teams. You've got headquarters in one place, you've got sales all over the country, you've got HR and finance. We believe the fourth vertical is education and job training. And then you've got franchisees, the incredible work of prop tech and co-working. And finally, with investment, this platform, although very secure today with end-to-end encryption inside video and inside chat, we will be targeting HIPAA compliant healthcare and telemedicine, which we think is huge. Hope that answered your question.
Thanks.
Tony, great job. The disparate customer sets and size of organizations, of course, can be challenging. When you think about partnerships, whether it's Slack, whether it's Zoom, Microsoft, we could go on and on, prop tech, technology companies, how do you think about what partnerships you might need from a distribution and product standpoint, given your global aspirations?
Yeah, that's a super great question. So number one, the cool thing is we can put with the touch of a button, Zoom in the room, Teams in the room, and we've done that. So we think we are an unbelievable source for going to an auditorium and coexisting with those tools. We've also adapted a Slack bridge, and in our Slack bridge, we mirror our Slack channel in our chat channel. So I think your question is awesome, and we are a platform to play in that's really, really elegant. We believe in a go-to-market strategy that the right thing to do is to co-brand and offer white label, just like we've done with Hitachi. So we think that that's an unbelievable strategy, as some of these companies, and by the way, we've got probably 4 or 5 right now reseller platforms where they're white labeling and taking this to market within their vertical.
Thank you.
Yeah, thank you. Great question.
This is super interesting and really timely, obviously, to get kicked off right before everyone decides they have to work remotely.
Right.
So as you think about, I think you've mentioned some of these, but as if there's an organization that already has things up and running, like a Microsoft Teams or similar, something like that, kind of what are the additional add-on functionalities that really push people to want to integrate and add your service as well, or to replace an existing service?
Yeah, so we really believe that what we're really augmenting and replacing is real estate. As people decide how they're going to approach their new environment, we really are enabling the opportunity to have a place that people go where they're super visible to one another and to their team. So that's what we're super excited about. A simple example might be a law firm that we've got that's LA, Houston, and Dallas based. And in that law firm, this is live and this is today and this is right now. The reason the law firm went with it is because they want to have visibility to their lawyers across the country. So they've literally got the opportunity to hover and see that Emily's in, and they've got the opportunity to see that that's Melissa Green in. So that's the deal, is we are augmenting in PropTech virtual real estate and then coexisting with all your favorite apps with the touch of a button.
Thank you.
Awesome. Thank you guys so much. Founders, thank you so much for pitching today. And judges, thank you so much. You guys have a tough job. Judges are going to head back and deliberate, and then I'm going to bring it back over to Wendy.
Welcome back, everyone. I hope that we had a interesting startup pitch. Let's go ahead and head to the networking side of the house for the next 5 to 10 minutes. I believe the judges may be in deliberations as we speak, and we'll see you back here in 5 to 10.